David and Chris earn the same salary, work in similar industries, and today they're moving into identical $400,000 homes right next door to each other. Fast forward 30 years to the end of their mortgage terms. David paid the expected price for his home, but Chris paid an extra $250,000. This gap wasn't caused by a smaller down payment, a different mortgage lender, or hidden closing fees. The disparity traces back to a single three-digit number attached to their names, their credit score. This small number acts as a quiet financial filter, ultimately dictating the true hidden cost of nearly every major life decision. Many people assume a high credit score indicates wealth or a high income, but the major credit bureaus don't actually track your net worth or your bank balance. Instead, the score operates as a behavioral algorithm, a strict measurement of how consistently you follow specific financial habits over long periods. To see how that algorithm treated our two homeowners, we have to look at the years of data they generated before they ever applied for a mortgage. David's history shows responsibility. He never misses due dates and maintains low credit utilization, using a tiny fraction of available credit. Chris's inputs are erratic. He frequently misses due dates, keeps balances maxed out, and applies for new cards in short windows. When the lender reviewed these files, they didn't see two equal earners. They saw two entirely different risk profiles generated by those daily habits. The lender translated Chris's history into a high-risk label, penalizing him with an interest rate significantly higher than David's. While a small percentage difference seems minor on paper, it compounds over 360 months. For Chris, that risk penalty equals the $250,000 in extra interest we saw earlier. This same risk assessment algorithm dictates more than just mortgages. It determines the rates you pay on auto loans and whether you're approved for credit cards at all. In many states, this score also acts as a gatekeeper for apartment rentals, utility deposits, and even your auto insurance premiums. Poor credit functions as an invisible tax, making almost every aspect of your lifestyle more expensive. Most of us obsess over how to earn more money, yet we often remain blind to the borrowing systems that drain that wealth away before we can ever invest it. Your credit score is a fluid system. It isn't a permanent judgment, but a metric you can optimize with intentionality. You can force the algorithm to work in your favor by following a systematic 30-day framework. The first step is to audit your credit reports. Manually identifying and disputing bureaucratic errors or incorrect penalties can immediately remove weights dragging your score down. Next, feed the algorithm better data. Set up autopay to ensure bills are on time, lower your credit utilization, and halt unnecessary new credit applications. Maintaining this consistency protects your cash from interest penalties, ensuring your income goes toward building your own wealth rather than paying for the privilege of borrowing. To start, find your baseline by checking your current credit score this week. Identify just one habit from the framework, like setting up an autopay reminder, and implement it today. These small mechanical tweaks to your financial habits are the ultimate leverage for saving hundreds of thousands of dollars over your lifetime.